If you wanted to be an active investor, how do you analyze and value an individual stock? For the purposes of this example, let's take a look at the McDonald's stock and the Coca-Cola stock today. By the way, MCD is a ticker symbol of McDonald's, so if you wanted to buy one share of McDonald's, that's what you would be buying. If you wanted to buy one share of Coca-Cola, you'd be buying that ticker symbol, KO. That's what you'd enter into your brokerage. Now, at the time when we're recording this video, McDonald's is trading for around $300 a share, and Coca-Cola is trading for around $100 a share. And now, if I were to ask you which one is a bigger and more valuable company, many people would say McDonald's because, well, their stock is more expensive than Coca-Cola. But that's the wrong analysis. Remember, the stock price, this share price, is the value of the company divided by the number of shares. McDonald's or Coca-Cola can change how many shares are out there, and that will then ultimately change the stock price. And this is where you want to take a look at the value of a company, which is called the market capitalization. Take a look. McDonald's has a market capitalization of around $220 billion, while Coca-Cola has a market capitalization right here of around $10 billion. So yeah, the McDonald's stock is trading about 3 times higher than the Coca-Cola stock, but that doesn't mean anything. What you want to pay attention to is the value of the company, because the McDonald's company is more than 20 times bigger than the Coca-Cola company at the time of me recording this video. But that still doesn't answer the question of what's a better investment? And this is where now your analysis will start as to where is a better place to invest your money, where you can see the best growth. And one question that you could ask is, for every dollar of profit, how much is the valuation going up? Because you want to take into account how valuably investors are looking at McDonald's profits versus Coca-Cola profits. And this is publicly available as well. One thing that you can take a look at is the P/E ratio, which shows how many times profit this company is being valued at. And if that's confusing, I'll explain exactly what that means, but take a look at this. McDonald's has a 27 times P/E ratio versus Coca-Cola has a 17 times P/E ratio. Now, to really understand what this means, let's assume that I have a hypothetical company that's making $100 of profit a year. If I'm making $100 of profit a year, how much is my company worth? Well, it depends. If my company is trading for 27 times earnings like McDonald's is, that means you take 27 times 100, my profit, which means my company would be valued at $2,700. But if my company had a 17 times multiple, now you take 17 times 100, my profit, and now my company is worth $1,700. So just because a company has more profit doesn't necessarily mean it's going to be worth more, because you have to also understand this multiple, and this means that McDonald's is trading at a more expensive multiple than Coca-Cola is. Is it better or worse? Well, it's really ultimately up to you as the investor to decide what types of multiples make sense for you and which companies you think will have bigger growth potential. And this is where you want to think about, well, which companies should I be researching? And the simplest place to start is just look around and see what you're buying, what's around you. Are you buying Apple products or Google products? Are you shopping on Amazon or are you shopping at Walmart? This can give you a very nice initial way to start, but then if you really want to be more advanced, this is where you can start investing in your own research as an investor to pay attention to what shifts are happening in the economy. For example, my team at Briefs Pro publishes a weekly newsletter where we break down a market shift that we see happening, because we have a team of analysts that are studying the markets. They're traveling the country, they're going to trade shows, they're talking to industry experts, and they're looking to see what changes are happening in the economy and what industries could be seeing more money in the future, and we publish this into our pro reports. This is a paid report, this is a paid service. If that's something that you're interested in after you join Market Briefs, you can also learn more about Briefs Pro to see if there's something worthwhile for you to subscribe to. We have thousands of investors that have subscribed to Briefs Pro and really love the research and reports that we're publishing. But if you are interested in that more advanced research, you can check out Briefs Pro. That's what we do there. And now let's talk about which mistakes you should avoid. That way you can keep more of your money and hopefully grow your money a lot faster. Let's start with the basics. Stocks go up and stocks go down. Market crashes happen, recessions happen, and they're going to continue to happen. Every time you see a market downturn, people panic, they freak out, and then they lose money. I want you to understand the cycle, that way you can use it as an opportunity, because the reality is over the last 100 years, we have seen 16 recessions. We've also seen 25 stock market crashes, which is a bear market. A bear market, by the way, is when the stock market falls by 20% or more. We have seen many crashes, many recessions, and we're going to continue to see them happen in the future, and the same cycles happens every single time. I call it poop. Panic leads to overselling, leads to opportunity, leads to profit, because the financially savvy investors that use those downturns to buy when everybody else is selling can come in and buy great investments at a great price. So you have to remember that market cycles happen and stocks don't always go straight up, they go up over the long term. The second thing you want to remember is that you don't actually lose money unless you sell or unless the stock goes bankrupt. So if you buy a stock for $100, it goes down to $50, you don't actually lose $50 unless you sell. And then if it goes back up to $200, you don't actually gain that $100 unless you sell. Keep that in mind, because sometimes that psychology can entice you to make decisions that you're not ready to do. Number 3 is trying to time the market, because the reality is no one knows what's going to happen tomorrow. Financial opinions are like armpits. Everybody's got a couple and some stink more than others. Everybody has an opinion, but no one has a crystal ball. Number 4 is ignoring your fees, your expense ratio as a passive investor. Those small little expense fees can add up to a huge cost over the long term. In fact, a 1% expense ratio can end up costing you more than a quarter, more than 25% of your total investment portfolio over the career of your investment journey. Why? Because it's a 1% fee that you don't just pay one time, you pay it on every dollar that you invest and every dollar of profits. So while your money's working to grow, your fees are also growing as well. Number 5 is YOLOing all in on one stock, because yes, it can be fun to dump all of your money into a random stock you read about on Reddit, but if you don't know what you're doing, you're also taking on all the risk. And if you don't know what you're doing, you're really kind of just gambling. Mistake number 6 is investing more money than you're willing to lose, because at the end of the day, you don't want to look at your stock brokerage account like a checkings account. It is a long-term investment account. Think of that money as gone. Hopefully you're going to grow your money many times over, but if you need your stocks to pay your bills, you're doing it wrong. Take your extra money, invest that in stocks. Don't invest the money you need to pay your bills. And finally, the 7th mistake you want to avoid is being inconsistent. The reason why so many people lose money isn't because they made the wrong investments, it's because they didn't invest their money. And this is where you want to remember the way you build wealth is by sticking with it for the long term and sticking with it through the ups and downs. When you become inconsistent, you invest a little bit of money now, and then a couple of years later, you look back and say, oh, I wish I kept investing. You put some more money in now and next month, and then you forget about it, and then you look back at it 2 more years later. That strategy is a recipe for disaster. Stay consistent with what you do. Remember the principles, remember your strategy, and stay calm through the emotion. There's going to be a lot of craziness ahead. This is something that's been happening forever now. We're going to see ups, we're going to see downs, we're going to see booms, we're going to see crashes. But at the end of the day, your goal is just to work to keep accumulating more assets, to grow your wealth and grow your portfolio. And if you stick with it, you will surprise yourself, because the more you do, the more you learn. Yes, mistakes will happen, but just stick with it, and hopefully my education here and my Market Briefs team plus my Briefs Pro team can help guide you along the way. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.